Hey, good afternoon, everyone. Marty Mazzora here. It is August 4th, 2025. Some 3+ hours after the market closed. You will receive this sometime tomorrow morning, you clients, in your email inbox. Per my written note earlier today, I will be away from the office from Wednesday on. So this will be it for me this week. I did say on Friday I thought I'd offer something up over the weekend, but by the time I was done with my weekend analyzing, I just didn't really see the need to throw anything at you. So today I'm going to actually keep pretty brief. There was a lot of data to parse. Our PWA index, which is 43 data points that give us a feel for overall general conditions, actually dropped to -20 from about -16. That was, of course, influenced by Friday's jobs number, which I'll talk a little bit about today. I did talk about that on Friday. So what a -20 in our index says is that recession risk needs to be respected over the next, say, 6 months or so. It's not a prediction. It's just a measurement of overall risk in the economy. So with regard to the jobs number, I already told you what the numbers were on Friday and the revisions. It was a surprise to me that the president opted to fire the chief or the head of the Bureau of Labor Statistics, citing political motivation for those negative revisions. So not going to judge right or wrong there, or whether that's accurate or not. I'm going to talk about just what we see or what we think about when we see negative and or positive revisions in employment numbers. What they signal to us, and they've been a pretty reliable signal historically, is where we sit in the economic cycle. Now, of course, when they have a deadline and they have to tell you what the data thus far have suggested about the employment picture, they give you that. And then more data come in, analyze, and if they decide that they need to revise those numbers, they will. Good, bad, or indifferent, that's how it works. Early in an economic cycle, coming out of recession, revisions tend to be on a very strongly trending basis. They tend to be positive. When they go back and redo it, they say, oh my gosh, more jobs were created than what we originally thought based on the data we had at the time. Toward the end of the cycle, as the economy begins to peak and ultimately roll over, assuming there is still a business cycle out there, then the revisions are consistently negative. And they've actually been that way for a while. I mean, they were consistently negative last year. And in fact, there was a massive annual revision that said the data had overstated the jobs creation between like March 2024 and March 2025 by 800,000 jobs. So make no mistake, under both regimes, both political parties, late in the cycle, you tend to get these negative revisions. And the one that we just got really didn't surprise us, and one reason being this screen in front of you. The top panel is the Institute for Supply Management Manufacturing Index, which came out on Friday for July. Tomorrow we'll get the Services Index, which is the orange line, and I believe this week we should get the Small Business Employment Report as well. So this is a sentiment survey, and this basically says, are you hiring? And do you plan to hire over the next 6 months? Below 50 means net negative. And you can see we haven't been in the positive since January of this year. So the manufacturing space, purchasing managers that work for private U.S. manufacturing companies are saying they're not hiring people or they're laying people off. In the services sector, you can see it has been better, but since February, it's actually been below 50 as well. So I guess you could say that, yeah, it was just barely above 50. So pretty neutral here, and then negative for June. We'll see what they say about July, but that would suggest that, a negative revision wouldn't be too big of a surprise. And then small businesses are very much in negative on hiring. And you can see they've been kind of falling off a cliff ever since April. So the private sector data has been suggesting that the jobs market has not been so good out there. So I was not at all surprised with Friday's number, as I suggested on Friday. So we shall see. Now, in terms of what the administration would, of course, prefer to see, any government would, under their watch, good, robust jobs production, right? A good, healthy labor market. Thing is, this particular administration has also been really hitting the Fed hard in the press to lower interest rates. Well, make no mistake, if we have a robust jobs market, the Fed will not be cutting interest rates. They just won't be. So actually, weakening jobs data is supportive of those who would like to see the Fed cut interest rates. Now, Friday, we had a really big sell-off in stocks. I mean, the NASDAQ was down over 2%, the S&P well over 1%, the Dow, 500 some odd points. And it was a rough week. It was just a bad week overall from Monday to Friday. So the narrative was that weak job number really spooked the market. And as I keep saying, this market is not priced for an economic slowdown. No way, no how at these valuations. So it would make sense that the market would sell off. But at the same time, I was thinking it's interesting because this is really going to increase the odds of a Fed rate cut in September, which we've been saying is pretty likely. We didn't think a July rate cut would be at all appropriate. But if the data were going to come in like we thought it would, then September probably will be very appropriate. So suddenly you wake up this morning and Fed funds futures, and even on Friday, started giving you like an 80% chance of a Fed rate cut in September and then another one in December. If Friday's any indication, you will absolutely get those. Now, that should have been something that the market would love. But on Friday, we also had the expiration of the deadline for these reciprocal tariffs. And leading up to Friday, the president had been announcing what amounts to an overall tariff regime, probably 50% worse than what the market had been discounting, meaning going from 10% across the board to 15% across the board, which, make no mistake, ultimately becomes a real headwind for the economy. So what I'm thinking is that today the market woke up and said, okay, you've got the tariff headwind, but we've got the new spending act coming up from behind that's going to be stimulative. And with the jobs data showing weakness, the Fed's got the green light to cut interest rates. So you've got the spending bill, which is going to spend a lot of money. You got the Fed cutting interest rates. Now, those two by themselves would be very inflationary and ultimately, I think, a big problem for, say, the stock market. But then you've got the tariffs that can provide a negative economic response, somewhat disinflationary. It's not intuitive because tariffs mean higher prices, but if they mean a slowing economy, they ultimately become disinflationary. It's also saying that taxes are disinflationary and tariffs are an increase in taxes. So it could be that the market is kind of parsing it all and saying, there's a balancing act here and we should be bullish. We should be optimistic. I'm not so sure the market has it right at these valuation levels. I think this sanguineness, and I'll call it sheer complacency, is very dangerous this late in the cycle, but we'll see. I watched an interesting podcast, a gentleman who I respect, who pretty much bases his research on global liquidity and has been a pretty accurate forecaster, is not bearish for the rest of this year. He says there's plenty of liquidity out there and that should keep assets buoyed. He's not real bullish on U.S. equities compared to other places. He sounded very bullish on Japan ultimately. But he said that, I don't expect anything super bad to happen in the second half of the year as long as we have all this liquidity out there. However, his model says that liquidity dries up a bunch by mid-year 2026, and then he says we have some problems. So there's the things we capture in our own analyses and then the folks who we pay for theirs. There's a liquidity picture, which I think is very, very important to look at, and folks like that can draw that for us with their tools and so forth. So, it's like I said Friday, I think there's legitimate cases to be made on the bull behalf and on the bear behalf for the second half of the year, which leaves us staying diversified, being in a position to make money if it's going to continue to be a good year, and being hedged in a way that we don't get hit too hard if indeed we do see what is really inevitable. I mean, trees don't grow to the sky and stocks don't start, big, robust, sustainable bull markets from these valuation levels as I've illustrated for you. So it's not a matter of if, I don't think. I think it's just a matter of when. And there's nothing harder to do than time markets, particularly when you get in that really late phase of the cycle. And I think we are very much in the latter phase. Again, question is how much longer can it go? All that aside, let's look quickly at the charts. So the S&P daily chart, again, nice rally today. But technically speaking, pretty normal. In fact, virtually to be expected, if not today, soon. And that is a filling of this gap on Friday. So here's the market breaking out of this rising wedge pattern on Thursday and then plummeting down on Friday, closing a little bit off the bottom. The bottom would be right at the bottom of that shadow there. And then today closing right back on, just enough to fill that gap. Happens all the time, right? So this level right here could be resistance when we wake up tomorrow morning. If we get more good earnings like we had of late, for example, maybe not. Maybe we barrel right back through there. And then this uptrend line here would be the next level of resistance. But because of this waning momentum, it still is your bearish rising wedge pattern, even if we fall back into that. So again, this would be the norm you'd expect to test. Technical analysts would wait for this to reverse and then probably go short. Below the Friday level would be a massive sell sign if that were to happen over the next few days, let's say, particularly when we've got these real bearish divergences going on. With the NASDAQ 100 index or the ETF that tracks it, it's essentially the same thing right here. Filled the gap right there. We did close above the 20-day moving average, which is positive for this particular one. Had that big bearish engulfing candle, and I put a dotted rectangle over the number of days that it captured there. Negative sign. Bearish divergences, we shall see. I mean, this is earnings season, so these patterns could definitely fail, but at all-time highs, there's something we need to pay very close attention to. As for the dollar, this is probably going to make more sense when I show you yields. You can see it tried to rally today, came down, just had a little bit of a rally, closed lower than the close on Friday. Rallied a little bit from the open. This means that it opened way down here and then rallied just a little bit and then closed off of today's highs. That's what the wick of the candle is, the range. The body is where it opened and closed on the day. The 10-year yield, as you can see here, folks, this right here is a very classic falling star pattern. Right, this one right there, this last one. You see what I mean? Long tail, the body right there at the bottom. So what does that mean? That means that yields actually opened up higher and then got sold into big time. Okay, or I should say, bond prices opened up lower and yields were higher, and then bonds got bought big time before the end of the day. So if Friday was all about a weak economy due to the jobs number, stocks actually should have fallen with yields, right? Because I think the market sold yields or bought bonds because of the concerns over the economy, and then what that means for interest rates going forward. If the stock market were that worried about it, it would have followed yields lower today. And I think the market is partying on the prospects potentially for the Fed cutting interest rates. So we shall see. And then gold closed higher today. Now, gold and stocks should be somewhat negatively correlated right here, meaning when market's worried, like on Friday, you see how gold had a real nice day. But the market rallied today, and gold closed a little bit higher today as well. Gold will also do well, potentially in a falling yield environment. So, you could say the setup to own gold isn't so bad right here. We do own a good chunk of it, but the technicals just tell me that, just a little bit of a catalyst that would have folks take some of these huge profits they've had in gold wouldn't take much. And you can tell that people are doing some selling into these rallies. So remains to be seen. This is not a comfortable chart for me on gold, although the story backdrop isn't necessarily all that bearish. If it's going to be great for stocks the second half of the year, it's probably not going to be great for gold unless it's all about just falling yields. They both could rise together. So again, very, very interesting setup across the board. Lots of divergences in terms of correlations are changing. We work really hard to understand what is driving these correlations, and I think we do a pretty good job of understanding that. And then it allows us to view different asset classes in terms of what the signal is that they are giving us. So bonds and gold today are potentially signaling the sentiment or the prospects for a weaker economy going forward. If stocks are rallying on that, they're basically just believing the Fed can fix it. History of the Fed fixing it, isn't necessarily so good once that recession ball starts rolling. It's not like a rate cut or two gets to fix it. And when earnings fall from these levels, things can get pretty ugly. But right now, at least for the second quarter of this year, the earnings are coming in pretty good. When you read the earnings statements and you look at the commentary, lots of worry out there, particularly about the tariff setup going forward. So we shall see as the data come in between now and the end of the year. And I'm going to stop for now and be back, probably Tuesday or Wednesday of next week. Folks, thank you. As always, I really appreciate you for watching and listening, and hope you have a great week, and I'll talk to you next week. Take care. Bye-bye.